Continue on the economic and social consequences of money laundering. In social costs, significant social costs and risks are associated with money laundering. Money laundering is integral to maintaining the profitability of crime. It also enables drug traffickers, smugglers, and other criminals to expand their operations. This drives up the cost of government expenses and budgets to combat the serious consequences that result due to the need to increase law enforcement and other expenditures. For example, increased healthcare costs for treating drug addicts. Financial organizations that rely on the proceeds of crime face great challenge. Inadequately managing their assets, liabilities, and operation, as well as in attracting legitimate clients. They also risk being excluded from the international financial system. The adverse consequences of money laundering are reputational, operational, legal, and concentrations risk, and they include loss of profitable business, liquidity problems through withdrawal of funds, terminations of correspondent banking facilities, investigation costs and fines, asset seizures, loan losses, reduced stock value of financial organization. Reputational risks. Adverse publicity regarding an organization's business practices and associations, whether accurate or not, will cause a loss of public confidence in the integrity of the organizations. As an example, reputational risk for a bank represents the potential that borrowers, depositors, and investors might stop doing business with the bank because of a money laundering scandal. The loss of high-quality borrowers reduces profitable loan and increases the risk of the overall loan portfolio. The depositors might withdraw their fund. Moreover, funds placed on deposits with a bank could be unreliable as a source of funding once depositors learned that the bank might not be stable. Depositors could be more willing to incur large penalties rather than leave their fund in questionable bank, resulting in unanticipated withdrawal and causing potential liquidity problems. Operational risk. The potential for loss results from inadequate internal processes, personnel, or system, or from external events. Such losses can occur when organizations incur reduced or terminated interbank or correspondent banking services, or increased costs for these services. Increased borrowing or funding costs are also a component of operational risk. Legal risk. There is potential for lawsuits, adverse judgments, unenforceable contracts, fines, and penalties that generate losses. Increased expenses for an organization and even the closure of the organization. For example, legitimate customers could become victims of a financial crime, lost money, and sue the financial organization for reimbursement. There could be investigation conducted by regulators and or law enforcement authorities, resulting in increased costs as well as fines and other penalties. Also, certain contracts could be unenforceable due to fraud on the part of criminal customer. Concentration risk. The potential of loss result from too much credit or loan exposure to one borrower or group borrowers. Regulation usually restrict a financial organization's exposure to a single borrower or group of related borrowers. Lack of knowledge about specific customers who control the customer or the customer's relationship to other borrowers can place an organization at risk in this regard. This is particularly a concern when we are related counterparties, connected borrowers, and common source of income or asset for repayment. Loan losses can also result from unenforceable contracts and contracts made with fictitious persons. For these reasons, international bodies have issued statements such as the Basel Committee on Banking Supervision's guidelines on the sound management of risks related to money laundering and financing of terrorism, and FATF's International Standard on Combating Money Laundering and Financing of Terrorism and Proliferation. Economic and social consequences of money laundering. Case example. In 2017, in Minneapolis, Minnesota, US, 21 people were indicted on sex trafficking and money laundering charges. The organized crime group OCG allegedly trafficked women from Thailand to cities across the US for sexual exploitation. The OCG dealt primarily in cash and conducted a sophisticated international money laundering ring to promote, redistribute, and conceal illegal profits. Funnel accounts were used to launder and route cash from cities across the US to money launderers in Los Angeles. A funnel account is a money laundering method that exploit branch network of financial institutions. It involves depositing illegal funds into an account at one geographic location and giving criminals immediate access to the money via withdrawals in a different geographic location. The transactions amount are kept under the AML reporting requirements in an attempt to avoid detections. In this case, funds were withdrawn in Los Angeles and then wired, transported as bulk cash or mailed to Thailand. Through the coordinated efforts of various governments and enforcement agencies, the human trafficking ring was taken down. The investigation resulted in 20 arrests, recovery of victims from active houses of prostitution, and seizures of hundreds of thousands of dollars in cash and numerous weapons. The indictment consisted of predicate crimes including sex trafficking, fraud, human trafficking, threat of force, and money laundering. The victims in this case were primarily poor women with limited ability to speak English. They were promised a better standard of living in exchange for USD 40,000 to USD 60,000 in bondage debts. Criminals gained information about their families and used it to threaten the women and prevent them from fleeing and becoming non-compliant. The operative of the money laundering ring helped their victim attain fraudulent visas and travel documents by forging bank statements and creating fictitious backgrounds and employment information. In the US, victims were escorted by a member of the OCG organization to a bank and instructed to open accounts in their own names. OCG members then took control of the accounts and provided the account information to co-conspirators to coordinate deposits throughout the US. The OCG recruited money mules to carry large volumes of cash on trips to Thailand and use a hawala system to transfer money to Thailand. The OCG moved tens of millions of dollars in illegal proceeds from the US to Thailand and elsewhere using this system. Collaboration between law enforcement and the private sector is essential to identify money laundering red flags. In addition, organizations must have mechanisms in place to report suspicious activities to regulators and law enforcement in the continuous fight against financial crime. Organizations need to sufficiently train frontline officers to identify fraudulent documents and red flags associated with human trafficking. Money laundering undermines the legitimacy of the private sector and weakens the financial sector, both of which are critical for a nation's economic growth. Criminals often exploit loopholes within various institutions to facilitate financial crime. This method undermines the legitimate financial system and exploits various markets, such as the labor markets. Money launderings are also promote crime and corruption, which slow economic growth and cause significant reputational risks. In addition, money laundering perpetuates other crimes such as human trafficking and smuggling, fraud, and corruption. These predicate crime exploit and victimize vulnerable individuals. Key takeaways. Money laundering promotes crime and corruption and slow economic growth. Money laundering exploits institutional loopholes and undermines the legitimate financial system and markets. Money laundering perpetuates other crimes such as smuggling, fraud, and corruptions. Collaboration among various agencies and the private and public sector is necessary to fight financial crime. AML CFT compliance programs and individual accountability. Regulatory guidance and legislation place individual accountability at the senior level of regulated entities when they have contributed to deficiencies in AML, CFT, and sanction compliance programs. In 2014, the Financial Crime Enforcement Network, FinCEN, of the U.S. Department of the Treasury and the U.S. Financial Intelligence Unit, FIU, issued an advisory to financial organizations, reminding them to maintain a strong culture of compliance and specifying that the entire staff is responsible for AML-CFT compliance. This advisory was followed in 2015 by Memorandum on Individual Accountability for Corporate Wrongdoing from the U.S. Department of Justice Deputy Attorney General Sally Quillen Yates. The Yates Memo, as it is often referred to, remind prosecutors that criminals and civil investigations into corporate misconduct should also focus on individuals who perpetrated the wrongdoing. Further, it notes that the resolution of a corporate case does not provide protections to individuals from criminal or civil liability. Although the Yates Memo does not specifically address AML-CFT compliance, enforcement actions issued by U.S. regulators against financial organizations demonstrate a continued focus on AML-CFT compliance deficiency. In the United Kingdom, the Financial Conduct Authority (FCA) published financial rules for the Senior Manager and Certification Regime (SM and CR), which are designed to improve individual accountability within the banking sector. In relation to financial crime, the SM&CR requires a financial organization to give explicit responsibility to a senior manager, such as an executive-level money laundering reporting officer (MLRO), for ensuring that its efforts to combat financial crime are effectively designed and implemented. The senior manager is personally accountable for a misconduct within the organization's AML-CFT regime. The New York State's Department of Financial Services, DFS, issued a final rule requiring regulated organizations to maintain transactions monitoring and filtering programs, reasonable designed to monitor transactions after their executions for compliance with the Bank Secrecy Act (BSA) and AML laws and regulations, including suspicious activities reporting requirements, and prevent unlawful transactions with target of economic sanction administered by OFAC. These final rules, which went into effect on January 1, 2017, includes very specific requirements concerning the implementations of transaction monitoring system, including risk-based models. Model should be risk-based and commensurate with the organization's own risk assessment and profile. Model performance calibrations. Organization must perform ongoing analysis and testing of the MLCFT models to assess the scenario logic, performance, model technology, assumptions, and model parameter setting. End-to-end, pre- and post-model implementation testing. End-to-end testing is required to ensure rules are validated and data are complete and accurate. These final rules are required regulated organizations board of director or senior officer to annually certify to the DFS that they have taken all steps necessary to comply with transaction monitoring and filtering program requirements. Although the law may seem New York specific on its face, numerous foreign banks are subject to the law because they operate in New York. Specifically, the law covers banks, trust companies, private banker, saving bank, and saving and loan association chartered pursuant to the New York banking law, as well as branches and agency of foreign banking corporations licensed pursuant to the banking law to conduct banking operation in New York. Moreover, the law also applies to non-bank financial organization with a banking law license such as check cashier and money transmitter. Individual accountability and consequences case example. In August of 2020, the UK's Solicitor Disciplinary Tribunal suspended and fined lawyers Stephen David Kitch for repeatedly breaching his professional anti-money laundering obligation. It is well known that several legal options exist globally to impose corporate liability. For example, in vicarious liability, an organization could be found criminally liable for the act of its employees. There is, however, increasing focus on individual liability for professionals when their behavior and action encourage, tolerate, or lead to regulatory violations or criminal activities. Individuals are now expected to conduct business responsible and prevent AML-CFT violations. Individuals, professionals are increasingly being held accountable for sector-specific crimes through prosecutions of linked financial crime offenses such as fraud. They may also be held accountable for their organization's AML-CFT failures. When persecuted individuals have been imprisoned, fined, suspended, or debarred from professional activities in regulated sector. On August 12, 2020, the UK Solicitor's Disciplinary Tribunal suspended lawyer Stephen David Kinch for repeatedly breaching his professional anti-money laundering obligations. Kinch failed to check source of fund and perform customer and third-party due diligence when establishing new business relationship. He did not review transaction while doing business with a company incorporated in Sinaloa, Mexico. In fact, he stated that transactions involving foreign nationals and overseas residents in a location where he had no connection or profile himself did not raise red flag for him. He admitted that the nature of the transaction being conducted was out of his expertise. Kin's actions amounted to serious misconduct with high culpability and harm involving significant monies over a 3 year period. Kins was suspended from practice as a lawyer for 15 months and fined Euro 5,000, after which he would be banned from practicing as sole practitioner, manager, or owner of an authority or recognized body. He was also forbidden from acting as compliance officer for legal practice or finance and administration for 3 years. Compliant professionals must recognize the risks and specific accountability that they personally face in their work environment. They should ensure that they are fully up to date with legislative and regulatory requirements specific to their role and sector. If they have any concern regarding integrity or behavior within their firm or businesses, they should escalate issue through the appropriate formal reporting or whistleblowing channel and document the fact. Key takeaway: regulators use power to sanction professionals who commit crime from their sector. Criminal courts can impose range of sanctions against guilty professionals, including persecution and imprisonment. Accountability for money laundering offences in professional capacity can have devastating financial, personal, and reputational consequences for individuals.